you go through 50, 60 years of experience with virtually no declines, and you somehow believe that that's the norm, and it is, except for the crisis that happens once in a century or half-century.
We are in the midst of a once-in-a-century credit tsunami.
That's one of the problems when you're when you have investment basically by committee or by intermediary institutions, where it's not your money, it's potentially your client's money. But what you need is backup of a verifiable source.
And so it's very hard to be the one wise man in a country when everyone believes something that's wrong. We will all believe something is true when it won't be true, and it's going to be very hard to prevent, unfortunately.
But commodities, I think, in the longer run are not going to be attractive if we are in a surplus world, slow growth world. I think there is another recession out there within the next year or two. Now, whether that would be called a double dip or simply another recession, that's sort of a judgment call. The point is, though, that I think now we are on the downside of the long cycle, if you will. There was a tremendous leveraging up, very high growth in the 80s and 90s. That, to me, ended in 2000. We've been on the downside. Now, we had the tremendous Fed ease and fiscal ease and the big housing bubble that kind of clouded that over. It masked what was going on. But I think we're on the downside. Now, if we're on the downside, we are probably going to see shorter expansions, deeper recessions than we had on the upside. And by the way, that will naturally carry over to other markets like stocks, which tend to mimic the economic cycle. In other words, you would tend to have more frequent bear markets, deeper, weaker bull markets, shorter in duration.
This is a secular bear market that began sometime in 2000 and for all we know is going to run to 2013, 2017, something like that. But what we've been enjoying since March is a cyclical bull market within that secular bear market.
QE1 didn't work, QE2 didn't work, QE12 will not work. When you have an economy that is delevering and you throw liquidity at it, do you think American families are just going to say, oh, we've got a lot of money, let's just go back into debt again, or let's squander our savings? American families have been shocked by the most devastating crisis and recession since the Depression. The idea that you can defer all of this by some massive injection of liquidity is really wrong.
Most financial advisors today are utterly useless in this climate now. So, the buy and hold crowd, the passive allocators, the plop half in equities and hope for the best, all that is rubbish. It's hurt people. It'll continue to hurt people. Not, picking up 2 or 3% dividends with horrendous risk to capital. You'll hear 95% of the people saying that they're buying every day, but if they have no liquidity, if they never told you to sell, if you have no cash, then it's absolutely pointless to tell people that everything's a buying opportunity.
I look forward to seeing you again at one of these conferences where we can be on the same panel and then get away and talk about things we can't even say on the radio.
I'd like to challenge the usefulness not just of new instruments but of large tracts of the whole financial industry, much of which is a net drag. I start with the investment management business because I think intuitively, obviously, you can see that we collectively add nothing. We produce no widgets. We shuffle the existing value of all corporations and bonds around in a cosmic poker game. At the end of each year, the investment community is down by 1% costs, the individuals down by 2%. And aggregate fees have steadily grown. As we grew by 10 times from 89 to 99, huge economies of scale were existing, but the fees per dollar managed grows. No fee competition at all, contrary to theory. Why? Agency problems. Asymmetry of information. The client can't tell talent from luck or risk-taking. And as we add new products, options, futures, CDOs, hedge funds, private equity, aggregate fees rise as a percentage of assets. There becomes a layer of fees and another layer of agents and fees. The more complicated and opaque, the more the client needs us. No wonder Putnam likes this. As fees go up by 0.5%, we reach into the client's balance sheet, snatch the 0.5% and turn it into income. It's almost magic, capital into income. But we lower the savings rate of our clients, savings and investment rate by 0.5% as our fees go up. So we get short-term GDP kick from our income at the expense of lower long-term growth on the part of the system. Similarly with the whole financial system. Let us say by 1965, the best decade we ever had, the 60s, there was a very financial service arrangement. Enough banking, enough letters of credit to get the job done. Adequate tools are vital. That's not the issue. We're talking the razzmatazz of the last 10 or 15 years. The financial system was 3% of GDP in 1965. It's now 7.5%. This is an extra 4% load that the real economy carries. The financial system overfeeds and slows down the real economy. The first 100 years up to 1965, the economy was like a battleship growing at 3.5% a year. Even the Great Depression bounced off it. After 1965, the GDP ex-financials grew at 3.2. After 1982, at 3.1. After 2000, at 2.3. All of these to the end of 2007, not including the current problems. From society's point of view, this 4% works like looting or an earthquake. Both increase GDP short-term, but chew up capital. They might as well be retirees or children, all these extra people in the financial business, but they are much, much more expensive. Economists have not studied the optimal size for finance. Indeed, a learned journal recently rejected a paper on the grounds that finance does not comment on social utility. That is perhaps why there is so little. The underlying problem recently has been touching faith in capitalism. This faith was based on 50 years of a dominant economic theory that was shockingly not based on facts, but on unestablished, unprovable assumptions, rational expectations. This has given us efficient markets. So why regulate new instruments if capitalism and markets are efficient? Or why regulate anything? So Greenspan, Rubin, Summers, and the SEC happily beat back Brooks Libourne trying to regulate new instruments. But as Keynes knew in 1934, markets are behavioral jungles, racked by changing animal spirits and by agency problems. Efficient markets assume symmetry of data on all sides. In real life, agents have all the data, and the principal clients know little. It's like taking candy from babies. The more opaque and complicated the new instruments, the easier the rip-off. There's now at LSE a Center for the Study of Capital Market Dysfunctionality, started by my former colleague, Paul Woolley, that is even now attempting in academies to establish that in the real-world condition, agents in finance tend towards getting everything. My God, I finished 56 seconds too early. Well, congratulations. Just consider that I spoke more slowly. Okay.
Thank you. Well, thank you, everybody.
None, not a single client on the face of the earth knew that all the people in the engine room believed in data that guaranteed a major bear market. How can that possibly be? Are we such a bunch of crooks that we can hold a belief of a disaster and not one client will know that we hold that belief? Had they spoken, however, they would have been fired. And had they managed the accounts that way, they would have been fired. The market's going to come down probably in an orderly manner with animal spirits fairly high and the economy and profit margins doing pretty well. It often happens that way. But if we just go roaring through on a spluttering economy with all the money flowing into speculation the way it does now, the way he's begging us to, incidentally, then come 18 months from now, we're set for another bust, and the piggy bank is empty. If we have another bust, what do we throw at that one compared to the last one or the one before? So career risk creates herding and momentum. Never be wrong on your own, says Keynes. Okay? Just look around, make sure what everyone else is doing. They're buying crazy overpriced growth stocks, jump in, and beat them on the draw. So this has been a wonderful cycle, this Greenspan-Bernanke cycle. Ride the wave and then beat them on the draw on the way down. Go short at the last minute like Goldman and cover your tail. And then ride up again and then leap off and cover your tail a bit and then do it again. And you make fortunes. Unfortunately, the institutions get completely ruined and the pensioners even worse. And the 401ks practically end up owing money. The last hurrah is worth looking at because that's 1929, 1930. And this will tell you all you need to know about last hurrahs. Market had come down, and off the bottom, in 5 months, it rallied 46%. It rallied 46% as industrial production dropped from plus 16, the highest in American history, to -9 in less than a year. 25% unraveling. No moral hazard. The Treasury in those days was liquidate the farmers, liquidate stocks. They had anti-moral hazard, and yet it rallied 46%. That's what happens because they feel it used to be so high, it must have had some significance. It's a kind of pre-efficient market belief in market efficiency. It had to mean something, surely it will bounce. It's a very powerful thought, and it's caused a rally after every such decline, even then. The bad news for us, because we're fairly purist value managers for mainly institutional clients, is we don't like to play games with overpriced assets. And that's the world that we're in now. The Fed is driving the S&P, which is overpriced, the Standard & Poor's 500, a broad measure of the U.S. market. It's driving it from already substantially overpriced into what I would call dangerously overpriced. This is about the boundary line. We expect on a 7-year horizon 1% only plus inflation from the U.S. market. And now as you push it up another 20% perhaps in the next year, it becomes dangerously overpriced, a bubble territory, and ready to inflict considerable pain. That's what we have to worry about. So you're caught between, if you want to be conservative, you've got to start taking counteraction now. If you want to go with the flow, don't fight the Fed, as they say. You should be prepared to speculate on very nimble feet. It's not our style as a firm, but I think it's probably a game that you could play with a pretty good chance of winning for a few more quarters.
A few more quarters, but at some point, or is it today, would you be recommending selling into the rally?
Our institutional clients sell very gracefully into this rally. We've already started to sell. We're not even averagely weighted. We're modestly underweighted. And you must remember, bonds are even worse than stocks on a 7-year forecast. So you get caught in this paradox. It's very tempting, and this is what the Fed wants, by the way. It wants us to go out there and buy stocks which are overpriced because bonds they have manipulated into being even less attractive. So we're being forced to choose between two overpriced assets. That is not always a terrific choice to make, because there is a third choice, and that is don't play the game and hold money in cash. And cash has a virtue that people don't appreciate. You don't actually find a strong correlation between top-line GDP growth and making money in the market. It seems like you should. The fastest-growing countries should give you the highest return. They simply don't. But there's only 4 of us that believe that story. Everyone else in the world believes that if you grow fast like China, you'll outperform in the stock market.
If we get housing pricing down, then all bets are off.
That's the biggest risk, it seems.
That to me,
shadow inventory and the real inventory. And the shadow inventory will grow dramatically.
It has grown dramatically.
Yes. There are millions of homes where people have not made any payments on their mortgages in 2 years. And the lenders are not throwing them out because they don't know what to do with the assets. But at some point, if you get another 5 to 10% drop in housing prices, that could really just transform that whole world.
I worry about that.
Yeah.
I'm more worried about that than I am of a double dip, so to speak.